Assalamualaikum and good afternoon. So 3 parts, the third part being the actual start of our panel session. So the first part is appreciation. Thank you very much to Bursa Carbon Exchange for the third installation of the Malaysia Carbon Market Forum. CIMB is grateful to be a part of this year's forum, just like how we were last year. Second, thank you to the panelists, whom I will introduce shortly, and their upcoming contributions, which I think will be interesting for the market to learn from. And third, thank you, MC, for saying that this is the best for last, because credit goes to the audience for staying all the way to the last session at the Malaysia Carbon Market Forum, because money talks, right? So that's the first thing. The second thing, so we heard throughout the day, well, let's start with Malaysia. We know that carbon tax will take effect as early as next year, 2026. We know that an emissions trading scheme is being discussed in Malaysia. We've heard throughout the day that Singapore already has a carbon tax, Indonesia has implemented an emissions trading scheme, and other ASEAN countries are progressing towards implementing a compliance mechanism. So with that, the demand for carbon offsets will take flight. And to meet that demand, we also heard how suppliers need to meet the demand from those companies that want to offset against the compliance mechanisms. Now, for suppliers to scale their carbon credit issuances, finance is needed. What the market is familiar with, private equity investors who would provide equity investment, commercial banks that would provide debt funding. But what I think the market is less aware of are these other transaction participants that can be risk mitigators within the transaction structure. So with that, it is my pleasure to reintroduce Wen from the Export-Import Bank of Malaysia as part of the larger Malaysian Development Bank Group. We have Will from the Asian Development Bank. We have Finn from B0, that is a carbon credit rating agency. And we have Natalia, Kita Earth, as a carbon insurer. Round of applause for them. So I structured this panel session 3 rounds. First round, each panelist will give an overview of the instruments that they have. Second round, how those instruments are risk mitigation for investors and lenders. And third round, how project developers can access their instruments as part of the transaction structure. So with that, let's start the first round. Starting from home, Wen, Export-Import Bank Malaysia. So do tell us about how Exim Bank is active in the carbon markets, and from the larger Bank Pembangunan Malaysia or Malaysia Development Bank Group, the Climate Finance Innovation Lab that Bank Negara Malaysia has asked Malaysia Development Bank to administer. Over to you.
Sure, thanks Harsha for that. So I'm from Exim Bank, but we are a part of a bigger group called the Bank Pembangunan Group. So we've been integrated and acquired by Bank Pembangunan, and under that bigger group itself, there's SME Bank and there's Exim Bank and of course Bank Pembangunan. And under Bank Pembangunan itself, we have this fulfil, which is Carbon Financial Innovation Lab, and that is an initiative under JC3, and it's by Bank Negara, as rightly say so, and it's also supported by UNDP and the World Bank. And we have our local DFIs, our local financial institute into it as well as collaborators and partners such as Maybank, CIMB Bank, M-Bank, and so forth and so on. So there's a lot of banks in there to support this particular innovation lab. And it's basically like a crowd-in platform. So there's a platform to look into crowding in a lot of financial funds in terms of supporting the innovation lab kind of projects. And the projects has to be something to do with benefiting Malaysia in terms of understanding our sustainability and our climate challenges, and to mitigate all these kind of climate challenges that we have, and to align ourselves with our national policy of meeting our net zero target as well. So right now there are 23 projects on fulfil, and some of the projects has been funded, and we are looking to take these projects up to the next phase of accelerator program. And accelerator program is going to start next week, as we say, as we are talking right now. And certain projects are going to capital financing as well. So it's moving quite rapid because we just launched fulfil June this year. And the response has been quite good. And we also look forward to the next cohort. So this cohort itself is moving quite rampant. And there's a lot of key projects that could help to mitigate our net zero target in Malaysia itself. And not only for Malaysia, certain projects are also Asian-wide. And that becomes really interesting. So we do encourage financial support on Seafield itself. The more financial support that we have, the better it is for us to scale the projects under Seafield.
Thanks, Win. So thanks for saying that these projects can be Asian-wide. So in light of Malaysia's ASEAN Chairmanship, it's a pleasure to have you, Will, from the Asian Development Bank, because you have an ASEAN view of the carbon markets. And I do know the Asian Development Bank has its own carbon market program and perhaps other activities that support the players. So let's hear from you on what ADB is doing in that space.
Yeah. So thank you very much. It's a real pleasure to be here today. I continue to be impressed by the quality of kind of the events that Malaysia is able to hold and the focus it has on this very important issue. So as you rightly point out, kind of ADB has a real focus on climate, and that's for very good reason, right? Asia has quite a lot of the world's population, quite a lot of its emissions, and the story and the battle of climate transition is being fought now in Asia in this particular decade. In other words, if we don't get on top of this issue, particularly with regards to energy, our hopes and ambitions with regard to limiting human-induced climate change, stand at risk. Okay, so the ADB generally is taking a big approach here. We plan to invest $100 billion of our own capital resources in Asia out to 2030. So that's quite a big number. 75% of our projects should be, climate projects, and over 50% of the overall finance that we provide, both to kind of sovereign operations and non-sovereign operations, should be tagged as climate finance. So that is finance that is supporting mitigation goals or indeed adaptation goals. So as part of that broader picture, we have a carbon markets program. We manage funds on behalf of our kind of development partner institutions. So that's typically governments, Government of Norway, Government of Sweden, who provide money to us. We structure that around funds, Government of Japan, to try and aggregate some of these resources. And the approach that we have is based on two prongs. One is to develop the market kind of architecture around carbon markets. So to work with countries, to work with institutions, to develop the plumbing, the connective tissue that allows carbon projects to be developed, allows them to be traded. And two is to work on the actual mechanics of developing projects. So we can provide upfront support in terms of capacity. We can provide upfront money in some circumstances to securitize a carbon revenue stream and provide that in the form of grants to projects. That allows you to get your project off the ground. It reduces a certain amount of risk. And with an institution like ADB or other IFIs, it reduces the risk of a project kind of not materializing or not materializing as it would do. Yeah. So those are the broad kind of strokes of what we do in terms of our carbon market program. I think I'll hand over to Finn.
Thanks for that, Will. So I think it's a nice progression. So we started with a local lead with Wern, and then we moved on to Will, regional support. So now we're going to B0 and Kita with regards to global participation. So over to you, Finn. When I first came across carbon credit ratings, I thought it was designed for bankers because you made it easy for us with the letter ratings, just like bonds, right? So that way the adaptability was simpler for us who are regular with the capital markets. So again, that's as far as I'll go. Over to you, Finn, on what B0 does.
Thank you very much, Arshad, and thank you indeed to Bursa Malaysia for the invitation here. Yeah, I recently came to APAC to lead our Singapore office, and this has been excellent in helping me network with the relevant people and join the most up-to-date debates, so I'm very grateful for being here. B0 is a carbon ratings agency, so we look at carbon risk, pure and simple. What we look at, really, is whether a project delivers genuine, measurable, permanent emissions reductions or removals over the lifetime of its project. And that's really the simple aim we have. And to do that, we look at the data, the assumptions, the science, the operation, the methods used of the project. All of those things are relevant to whether or not the project is effective. This is, this is delivered in a sort of detailed report that could be 70, 80 pages long. It's quite a technical, complex thing. But then to distill that information for a wider market, we present it in a letter rating. So AAA rating is a very high rating. It says that there's a very high likelihood that the project will deliver the emissions reductions it promises to deliver. And a very low rating, or a D rating, is a very low likelihood. And that's what it is. It's an opinion. It's an informed opinion based on 70, 80 scientists that we have now globally across 3 offices. But why is that significant? Well, really, carbon ratings were a response to a big gap in the market, which is that projects differ in terms of their quality at the project level themselves. And when we originally examined the market, we tried to look at the products themselves, whether they were likely to reduce emissions, and what the price of those projects were. And the finding was that there was no relationship, no correlation between price and quality. And this was effectively the problem we based the whole business around, and that's where the idea of ratings come from. But this matters for 2 reasons, really. One is impact. If we can't prove that the projects themselves are delivering real emissions, then there's no net zero. And carbon markets really can scale and deliver the potential we know that they can deliver. And the second thing is very relevant to this topic, which is the investability. There needs to be a relationship between price and ratings so that there is an incentive for investors to get involved, data for lenders to use to fund these projects, and indeed an incentive for the developers themselves to continue producing higher quality projects and be rewarded for those higher quality projects over time. So that's the thesis behind it. We are now, have a few offices around the world in New York, London, and in Singapore, about 160, 70 people, about a similar number of clients at this stage. And we've rated about 700 projects, or around half of the liquidity in most traded markets.
Thanks for that, Finn. So I'll pick a word that you used earlier with regards to investability. So again, going back to the simple comparable of capital markets. So aside from credit ratings, we also have credit guarantees or credit wraps on bonds, right? So again, that can be applied on carbon credit projects as well. But let's hear from Natalia, because it goes beyond that, right? There are carbon insurance products that cover non-delivery risk, political risk, and so on and so forth. So Natalia, do tell us more about what carbon insurance is about.
Yes, of course. And again, thank you very much for having me here. It's been a wonderful conference. So my name is Natalia Dorfman. I'm the CEO and co-founder of Kita. Kita was the first specialist insurance company dedicated to the carbon markets. We launched in December 21. And you're very right. It's a very relevant conversation, insurance, to this wider conversation about financing. When we set up Kita, the goal really was to unlock financing to scale high-quality carbon projects. We think insurance is an unlock because it is very difficult, if near impossible, to access significant finance from financial institutions such as banks, asset managers, large commodity traders, if there isn't a risk mitigation in place. And insurance is one of the most well-known risk mitigations used in really any asset class all around the world. And particularly now, as we're starting to see more debt finance being applied to the larger carbon projects, for example, the increase in pay-on-delivery offtakes is enabling that future revenue stream that can be financed against. What we're very much seeing is that those financiers are unwilling to deploy that level of capital without the safety mechanism of insurance. And so when we talk about the types of insurance that we're now seeing in the market, it is really becoming very similar to the types of insurance you would expect in other asset classes. So is it a credit wrap? We have a credit wrap. We would term it non-payment insurance. Non-payment insurance is used by banks. In certain jurisdictions, they can get capital relief when they use this insurance. It really has very few exclusions. And it would protect the financier of a carbon project to protect them against the risk of non-repayment of their financing. For carbon projects, that usually means the carbon credits weren't delivered to the off-taker and/or the off-taker didn't pay. We also have non-delivery insurance, which is our first insurance policy. This protects against the core risk of an early-stage carbon project, that they might have forecast the number of credits they're going to deliver in the future, but there are things that could happen to the project and the counterparties that mean those credits are never delivered. These could be unavoidable risks like natural catastrophe, they could be counterparty risks like fraud or negligence or insolvency, and they could be political risks like a host country expropriation or export license cancellation. All of these things very much put fear in the hearts of a financing entity and put obstacles in place to contractual negotiations, and insurance can take some of that risk away. And for certain countries around the world, again, we have the very well-established form of political risk insurance, which is for certain transactions when just the risk of the host country is too high to get past investment committees, or where the project developer themselves feels at fear of or at risk of losing their asset. There is traditional political risk insurance where our rating model applies a sort of carbon lens to it, and where you can protect against that expropriation, export license cancellation, forced abandonment, war, terror, civil unrest. And in the instance, if you have a corresponding adjustment or letter of authorization, it also can protect against that revocation. And so really, our insurance is very much focused on how do you unlock finance to scale high-quality projects, and thus we often work both with the financing entity as well as the developers themselves.
Thanks for that, Natalia, and thank you, all four of you, for the overview on the instruments that you bring to the table. Now, we'll start round two on how these instruments can be risk mitigation for investors and lenders. So for this round, I'll start with Finn, then on to Natalia. So Finn, starting with the ratings, and then Natalia on carbon insurance. And then we'll come back to the development banks on how co-financing with a local development bank like Bank Pembangunan or Export-Import Bank and Asian Development Bank at the regional level is also risk mitigation. So over to you, Finn, on how investors and lenders use ratings for carbon credit projects as a risk mitigant.
Yeah, the million-dollar question, I guess. Carbon ratings, as I mentioned, they assess carbon risk. So that is how likely it is that the project is delivering genuine emissions reductions. But knowing the environmental risk, the carbon risk, is not just essential from an environmental perspective. It helps to translate it into the financial outcomes for the project. The way in which a rating does that specifically is that it is two ways, I guess. One is it translates it into a letter rating, which is a simple metric that can help screen projects. And how does it do that? Well, it helps compare projects that may be in different sectors or in the same sector, but in different parts of a country or a region. Projects that may be using very different technologies, using different approaches to how they measure the carbon impact over time. It's a simple letter rating that helps to shortcut deep analysis to compare those project investments. And the second way is that it provides a risk analysis toolkit, which ultimately leverages that information for financial decisions. Maybe I'll go into that in a little bit more detail. If you are a lender or if you are an investor, I think there are three ways in which a rating can help you. First is whether to fund a project in the first place. The second is at what cost it should be funded. And the third is what the future income of that project will be over time. Whether you should fund a project depends on a number of factors. But in short, stronger ratings help to reduce risk in that project and lower the risk. And it also helps to reduce the rates of interest that project can take over time. And we've shown that in working papers we have on discounting models, etc., which show the impact that this can have on individual projects. So that's whether you should fund a project in the first place. The other thing a simple rating screening can do is it can highlight key risks that might be very important to your investment thesis, to your principles about what you want to invest in, and it can highlight these risks and help you exclude that project at the beginning of the process. The second stage is at what cost, which is really essential for the underlying financial analysis of investing in carbon projects. And ratings help do this by leveraging the ratings price correlation that I mentioned earlier. Ratings are now beginning to help estimate what a project will sell for, which is crucial information any financial market needs to scale. And we're proud to say that we've been publishing some innovative research around that. There's a premium of up to 40% between rating notches on our scale. But it's not just ratings that show that. There are other metrics and standards in the market that's beginning to show that over time. But ratings is a ready-made tool for investors in this respect. And the third is around the future income of the project, which is, of course, related. And that crucially depends on the issuance volume of that project. How dependable are the forecasts that a project has made as to how much will be issued, at what pace, over what years, etc. And it's that analysis which is really key for understanding the future flow of cash and income of the project and where ratings can help. And there is a correlation between more stable and predictable issuances in a project and higher ratings as well. So the rating itself isn't just an environmental metric. It's an environmental metric that's designed specifically for financial transactions. Now, of course, it's used not just by investors and lenders. There's applications for developers, for governments, for buyers. But the concept of carbon ratings is adopted from credit ratings, which is really an investor and lender tool. And it's no surprise that many of the main investors and lenders in the market, one of their first ports of call is rating agencies.
Thanks for that, Finn. So one thing about carbon credit ratings is it can be done ex ante. So before an investor and lender gets into the project. So that's beneficial aside from the ex post rating that B0 prepares. Now over to you, Natalia. We have the ex ante ratings from a rating agency like B0. That being said, there can be trigger events throughout the lifetime of the project. And as an investor or lender, of course, the first thing is I'm just going to get insurance for all the trigger events possible to make sure that I will get my investment back. So perhaps the advice that we can get from you, how can investors and lenders use carbon insurance, aside from risk mitigant, how they make the investment or lending decision?
Yeah, that's a good question. I think when we work with our clients, we give them 3 sort of macro things that help them to get through the investment decision, help them to structure their transaction. One is trust. I once had a client say to me, "You're like a consultant, but if you get it wrong, you give us your money back," or give us our money back. Because, insurance companies, we do say no to projects. Right? There are projects that we think are too risky, and we do have skin in the game. And so we will only insure a project if we think it is a good project, and we are looking for projects that are high-quality ones that might fail for really unexpected reasons. We're not looking for a project that we think is going to fail. And so I think there is that trust. If you get an insurance policy from a company like Kita, you can go to your board and you can demonstrate good risk governance and good risk selection on the basis of that unbiased third-party opinion. I think we definitely see that as being a helpful tool for our clients. Second, related to that is smoothing. I think for most of the clients that we work with, and probably most of the companies in this market who are looking at financing projects at a larger scale than they've done so before, anything that you do for the first time is hard. And you have to not just bring along your team and the project, you have to bring along your wider stakeholders. And so for a financial institution, this is going to be your risk team, your ops team, your finance team. It can be the C-suite for certain projects, and you have to upskill each and every one of them. We see insurance as a smoothing mechanism to this because the insurance being utilized is usually at least a somewhat familiar tool to them that they can understand in the context of a wider project that they might not understand. So particularly the sort of non-payment insurance credit wrap, that's a very familiar insurance tool for financial institutions. So I think we provide that smoothing. And then in terms of just the actual risk transfer, the core premise of insurance is the transferring of risk that would be unsustainable for one entity to the shoulders of many. Like that is the core premise of insurance, and that's what we're doing here. We see clients either taking out the insurance when, one, they deem the risk just too high, So this might be a developer who is worried about the financial loss to themselves or the obligation, for example, to repay an onerous penalty in an offtake agreement. The risk might just be too high, it might take down their company, so they'd rather pass that risk to an insurance company. We see a lot of our clients, for example, the commodities traders, looking at it from a leverage perspective. If they're able to insure their investment into one project, then they can free up, they don't have to hold that back on their balance sheet, and they can free that up to invest into another project. So there's certainly a leverage aspect that people utilize insurance for. And then finally, capital efficiency. So again, from the bank perspective, if you can utilize a specific form of insurance to get capital relief, then clearly that makes engagement in that project a lot more capital efficient for you right away. Likewise, if you don't have to hold back cash on your balance sheet, whether you're an investor or a developer, again, that's more capital efficient for you. And we are now seeing more investors who are looking to LPs that are pension funds or other kind of institutional investors that have very strict return profiles. And with insurance in place that's safeguarding the floor price. So for example, if I'm a developer and I'm delivering credits against an offtake with a preset value, the insurance can come in at that preset value, and that's your floor price. And all of a sudden, from an institutional investor's perspective, like a pension fund, it starts to look like an asset class that looks familiar to them. So they can invest into an asset that's delivering a preset revenue stream at a floor price, and the floor price is insured. From our clients' perspective, if insurance can help them to access that wider institutional asset base, that's creating a great capital efficiency and scaling how they're able to engage into the market. So I think what we've seen is the insurance starting to come in that way where our clients are seeking to make carbon look as similar to other asset classes they invest into as possible. So for example, we have some real estate clients who do real estate investments. Again, they're used to investing into a building that's delivering rental incomes. They're looking at carbon as analogous to that. So they want carbon to look as similar as possible to other asset classes they know, but then they see the benefit of carbon as being uncorrelated to those other asset classes. And so going back to what I said at the beginning, where we see insurance as really an unlock to the institutional finance, I think these are the ways that we see it being applied, and we increasingly see it being normalized in the market.
Thanks for that. So thanks, Finn and Natalia, for the non-funded risk mitigant. So now we'll look to Wern and Will on the funded risk mitigant. So Wern, tell us more about how CFIL has that co-funding mechanism and how that co-funding crowds in commercial capital, including from the commercial banks.
Right, so we are a bank. We are financial institutions, and what banks are famously known for? They're quite risk-averse in a way, right? So zero risk would be the best report from a risk syndication. So what we looked at right now is that because we are not just a financial institution, but we are also a developmental financial institution, DFIs. So we had to take a braver step, take a braver move as well. But however, in terms of CFIL, as is under Bank Negara, it's under JC3, there's a good governance in terms of how we can mitigate risk. So there is a framework that we have. It's called Selection and Prioritization Framework. And there are 6 areas that we look at in terms of selecting the projects under CFIL to make sure that we have mitigate risks. We have done our due diligence as well. So we actually look into climate mitigation and adaptation potential into all these projects that comes in. It has to meet our national agenda. It has to be climate related, sustainability related, circular economy related, something that benefits towards our country and our national agenda. We also look into the alignment, as I said just now, with our national policies, with NERS, NETR, Energy Transition Roadmap, as well as our Malaysia Madani Roadmap as well. That's really important because whatever projects that we want to go ahead with and implement on the CFIL, it has to have that long-term trajectory, it has to have that long-term vision in terms of achieving the national policy itself. We also look into the core benefits, not just in terms of the benefits towards the investors, but the benefits towards the society, the impact that we create towards the country as well. So there's core benefits on both parts. Cost effectiveness as well. It's not just a very expensive kind of investment, but it has to be really cost effective in terms of how we do the selection. And we are quite prudent in terms of looking into those kind of selection criteria. Also on innovation and technology transfer, it has to be transferable. It's not something that just within the project itself. We look into transferring the technology towards the implementers, and it can be replicated, it can be scaled, and that's really important. And lastly is on the governance structure, and hence we have JC3 as our co-chair in terms of our governance, and that goes through a very stringent process, and it aligns with Bank Negara to make sure that we align ourselves with CRMSA, CCPT as well, and that's really important. And to make sure that those risks are being covered and those projects are somehow very scalable, depending on the range of the project as well. If you look into Seafield right now, we have projects starting from pilot phase towards scalable phase towards full implementation phase. So depending on your risk appetite in terms of how much risk you want to take into those kind of projects, and that's how we look into mitigating the risk under Seafield.
Thanks for that, Wen. Will, so we've heard from Finn on the ratings, Natalia on the insurance, and Wen on the Climate Finance Innovation Lab, co-financing. So based on the regional view, how does ADB's carbon markets program or aspects of it complement what we've just heard from the three panelists?
So if we think about it in terms of how to reduce risk from developing projects from the carbon market, we think about it in two ways. The first is kind of the institutional architecture. So that's working with countries, governments, and institutions to really build their capacity to be able to develop high quality, high functioning markets that have the liquidity to be able to provide these kind of demand and supply signals. It's also about working with countries to get an adequate level of ambition. And I think we've heard a lot today about how we get more supply, how we increase the liquidity, how we increase or reduce the cost of trading. What we haven't talked about too much is how do we get more demand. And in terms of carbon markets, where does the demand come from? It essentially comes from country ambition, global, regional, country ambition with regards to this issue. And then how governments choose to tackle that through carbon taxes, through ETS mechanisms, through carbon trading, through restrictions and pushes on certain types of industries and promotion and restrictions on other types of industries. That really is the kind of the unspoken elephant in the room of how do you get that. So to reduce the risk, we see that institutional component first and foremost. Secondly, we look at the projects, right? So we invest a lot of time in due diligence. And as Warren was saying, we look at various different factors. We're looking primarily, is the investment on the table a good banking project? Is it a bankable investment? Is it likely to pay back? What are the risks? And we look at, environmental, social considerations within that. Are we limiting the environmental, social considerations of what we're investing in? We look at governance. Is the company that we're investing in, or the institution, well governed? Are they able to do this? Do they have published plans around climate? Do they have an adequate kind of decision-making architecture around what they're trying to do? We then look at, okay, once we have projects in hand, how can we reduce the risk of them going wrong? And again, due diligence goes a long way towards risk reduction, as well as being a partner and monitoring what the project is doing. So we're not just giving you money, we are working with you on a journey to develop this project and other projects. We can then look at, in addition to that, other layers of kind of using concessional funds, so cheaper funds that you'll be able to find in the market. We can kind of front load and provide long-term contracts for carbon. That reduces the risk from kind of the off-taker and the developer perspective. We can offer fixed price contracts for the carbon that's being developed and offer a kind of a matchmaking service between supply and demand of these credits. And we're looking at other types of instruments for which are a bit more innovative. Results-based finance, nature-based finance, and how we look at this in the round, right? We don't often see projects which are just carbon projects. We see projects which have, as Warren was saying, multiple benefits. They're good business opportunities, first and foremost. They reduce your energy costs, they improve your efficiency, they reduce emissions, they're better for the communities that they exist within, they're better for the economy. Producing renewable energy is not just for the developer, it's for the country. It reduces your electricity costs, it improves your energy security. So we take great steps to try and understand what that is, quantify it, and then work with our clients and work with our counterparties to really make sure that that can be monitored, reported on, and built and improved on over time.
Excellent. So we'll move into the third and final round before we open up for questions. So the third and final round is more of advice or tips to the project developers that want to access the instruments that you have. So for insurance, it could be maximizing coverage per dollar premium. For ratings, maximizing the letter ratings. And perhaps for Asian Development Bank as well as the Malaysian Development Bank, passing through the due diligence in order to access that funding. So why not we start with Natalia and we'll work our way here.
My advice. Before I give the advice, let me just quickly frame how we price projects, or how at least most commonly they come to us. Most commonly, given that we do very early stage projects, most commonly we get a project before the deal structure is set. So we get a project, it is this type of project in this country with this standard, with this methodology. It's often pre-validation. And so step one is we price the project as a standalone basis. This is when we could also just say no, right? We have some no's, for example, if the natural catastrophe risk is too high. But otherwise, we will give you an indicative, very quick price just on your project. You are then able to take that price and model it into your sort of forecast of how you think your project's going to be structured into your deal contracts. If that price is broadly okay, we then ask for more detailed information on your project. Usually you can just give us a data room, but this will include things like audited accounts on the project developer. It will include your carbon modeling, these types of things. That will then refine the price on the project. But the thing that usually takes by far and away the most time is that people come to us before the deal structure is finalized. And so this is what I term the kind of chicken and egg stage of the insurance process. We can't give you a final price until we know the deal structure we're insuring, because our insurance sits behind your contract. And sometimes if you're the developer, you then are sort of struggling because you don't know the final price of the insurance, and it sort of sinks into the contractual structures. So I suppose my advice to developers or lenders or financiers who are in this stage is, I suppose, we can work with you to understand the most common deal structures in place right now, and we can work with you to make sure the deal structure is insurable. So I suppose there is a word of advice to engage with your insurance company early to make sure that how you structure your deal, like you say, maximizes the sort of level of insurance for the price. For example, ways that you can do this is some aspect of being conservative in your carbon modeling, potentially some kind of first loss in a project SPV, or a first loss in another deal structure, so there can be an aspect of loss on the project before it hits the insurance. Some deals we see now have security packages in place, although that's not suitable for every project developer. Or you could look to have potentially some aspects of insurance at the project level. So if political risk is high, for example, you might want political risk at the project level, or maybe for certain projects you could get fire insurance if the natural catastrophe risk is type high. So there's always ways you can structure it to make the insurance more cost effective, but there's always also a trade-off to that. So I think it's early engagement is certainly a word of advice that I would give to people who are engaging in this market. I think that would probably be my key one, because I see that as the biggest block that we get, that there's the deal structure isn't finalized when people come to us wanting insurance. So we're often thinking about how do we smooth that process for people. And it's a lot of work and a lot of engagement, but we have a lot of information now on what we'd say is increasingly standard deal structures that we might be able to input on.
Thanks for that, Natalia. Over to you, Finn, on the ratings.
So I'm not sure I would provide personal advice to project developers, but in terms of the engagement with our ratings process, we obviously work with a lot of project developers directly, increasingly, but also through their investors or buyers as well, who often request a rating as part of the deal structure. The way in which the rating is designed to support project developers is I would say three things. One is the letter rating itself now, as it becomes adopted in the market, is a very powerful marketing tool, right? So, and it often used as a threshold by investors, maybe in a slightly crude way, but it's still a way in which developers can access markets and access potential buyers. I I think the second way is that it's not just about marketing, but it actually helps to secure the offtake itself for buyers, which, particularly the market where it is, where there's a lot of developing standards, some regulatory uncertainty in different markets, is increasingly a requirement set by some of the major investors in the market. So that's where it's been particularly valuable. But I think the most exciting way in which a rating can support a developer, to me at least, is that we have found that project developers are now using it to optimize the projects themselves. So in a way that an investor might have originally used the rating to do some analysis, to feed back to the project design, developers are just coming to us directly, requesting a rating and then utilizing it to optimize investment decisions. You mentioned earlier the ex-ante product. That is our private rating before a project begins to issue credits. That's where that's happening most, which is that developers are making increasingly informed decisions to increase the quality of the project in a dynamic way at the beginning of the process. Now, that is really key, because if you go back to sort of our original thesis of the business, it was that there wasn't a relationship between price and quality. There wasn't a dynamic incentive beyond the initial methodology stage, a dynamic incentive over the course of the lifetime of a project to improve it, because project developers wouldn't be rewarded for it. And that's what a rating is designed to do, which is to provide that incentive for projects to increase quality over time and then be rewarded for it through the price. And that's the sort of market where you can help to reduce risk, increase the environmental impact of the projects, and obviously give everybody who's involved in pricing, buying, selling the credit more stability in terms of their investment decisions. I'd say one more thing for developers engaging with us, which is we make better assessments of projects the more information we receive. And I think if there's a tension with developers, it's the reluctance to share information, with anybody really, but with a rating agency. And in many cases that may be confidential, commercially sensitive information. We acknowledge that, and of course we'll have robust NDAs, et cetera, involved in that. But that is where it can really help to unlock, because if we don't receive specific information, well then that adds to information risk, which obviously can then discount the rating over time if you don't have the information or evidence to back it up.
If I just actually echo that, I think I would say actually one point of advice is to provide proactive explanations when there's a weakness. So because you don't want, for example, insurance companies, we have, within our ratings criteria, we have thresholds we're looking for. And sometimes there's an explaining factor if you're missing one. So for example, track record of a project developer is something we look at quite closely. There will often be a brand new project developer doing their first ever project. That in our book isn't a positive thing. However, if you know that, then you could come to us proactively, already talking about, but look at the individual experience of each of our founders, look at the partners that we work with in that particular country, things that then make us feel more comfortable. And I think that's probably quite a rare thing, that developers provide a kind of proactive explanation for where there might be a weakness. Another one might be financial accounts. They might have really weak financial accounts that as a standalone basis make us question their ability to be a going concern over the next couple of years, but they might also know they have an equity round near to closing. So sort of being proactive in telling us when there's a positive mitigating circumstance to something that might look otherwise negative is a very positive thing to either get an insurance policy at all or to get a more cost-effective one.
Thanks for that, Finn and Natalia. Information. So that's nice flow into what Will had mentioned in the previous round, the due diligence on the project, right? So it's not only a risk mitigation when co-financing with private sector capital, but also due diligence on the project in order to give funding to the projects themselves. So, Will, your thoughts on, or your advice to project developers on accessing the Carbon Markets Program?
I'll try and be brief, but I think my advice would be relatively simple. So I'd focused on three things: quantity, quality, and early engagement, and proactive kind of discussions to resolve any issues before they become issues. So on the quantity point, I mean, I'm a firm believer that if you have high quality projects that are going to push the needle, you will find money to do it. There is no shortage of institutional capital. There's no shortage of capital in the world. What it struggles to do is find a home. And this is one issue where that capital is looking to find a home. And there's a push from regulations, there's a push from ETS mechanisms, there's various pushes in the international system. And if you can find a way to tap into that market, all to the better. But that requires scale. So you need to think very big. What is going to shift the dial in your particular context? Is it primarily an energy issue? Is it a coal transition issue? Are there other issues that really will have a material impact on the topic of discussion? And if you can quantify that in terms of carbon and get some additional revenue in the revenue stack that you require, that's a good thing. And you will be able to, I think, again, in my view, focus on that. The second point is on quality. Focus on doing the best that you can with the project. It's not just about carbon, it's about a whole host of other things, bankability, environment, social considerations. Ultimately, the market will be successful if it moves and has a flight towards quality. And it's not just about price, it's about quality. We've heard a lot about there are premiums for good quality projects. We should all be seeking to get the best quality deals as possible, and that reduces the risk of things going wrong and improves the environmental integrity of the project, right? And if you can have a credible story about the quality and integrity of your project, I believe there are pools of capital buyers out there that are ready to support those kind of investments. Kind of lastly, on early engagement and proactive, you don't want to be in a position where you find there are fundamental issues with your project, you can't get insurance, you can't get the concessional money you need, you can't get the carbon price that you need in order to make your project effective. Plow a lot of effort into the due diligence, into the preparation of the project, and marking it appropriately. And as I said, I believe that there will be sufficient opportunities for you to fund those things. If you can find something which really moves the dial, and there's a convincing story about its development impact in climate and other things, there is capital out there. Thank you.
Thanks for that, Will. Early engagement. So when you started us off at home, it's nice to end at home as well. So building on Will's early engagement, how can developers get early access into CFIL, which has that accelerator program?
Well, I think my answers will not deviate much from the panel because they've said everything correctly. So we look into early engagement definitely, because that's where you can actually see, how we can actually scale the project. So when it comes to scalability, it's really important that these projects are scalable. And we look into innovation as well as a key factor. So innovative kind of solutions towards our energy transition, for example, with the themes that CFIL are currently looking at, which is on climate, energy transition, circular economy, sustainable agriculture, as well as nature-based solutions. So if those projects are within those themes, and with early engagement itself, we could actually look into early participation, which is really important. And that's where, under CFIL, not only just financing that CFIL provides, but also in terms of knowledge and skills transfer. And you can get access towards knowledge and skills with our partners on UNDP, World Bank, and so forth and so on. And through our program itself, we have an accelerator program, and that's where we help certain part of the projects to accelerate your program, to make it much better in terms for you to get financing. And that's where it's easier for financing to come on board when the project is much more refined in that sense. Yeah, so again, nothing much to add on, but we look into innovation, we look into quality, and we look into early engagement as key factors as well.
Thanks for that, Wen. So with that, we have 5.5 minutes left to this panel session. So I'll open up to one question before I get each panelist to give a 30-second closing on how their instruments grow local and ASEAN carbon markets. So if anybody has that burning question, do walk up to the microphone. Of course, our speakers will still be here after this panel session for you to have one-to-one Q&A. So that one burning question, anybody? Okay, I'll take that as a sign that you want to have the one-to-one after this, right? So Arshad, give us more time to have that one-to-one engagement with the panelists. So with that, I suppose I can then give each panelist 1 minute then on how their instruments can support the growth of local and ASEAN carbon markets. So Wen, why not you start us off?
Sure. So just to add on my point, because we also look into a lot of core benefits. So bringing back to my point again on impact. So we actually look into projects that provide impact. Impact is not just on financial impact, but social impact as well. Community impact in terms of how this will upgrade certain part of the society, so community as well. So that's really important. How we can scale is basically looking into certain projects that we do. I'll just give you an example of a project that ASEAN actually supported. So we supported a project in Sabah, Sandakan, on looking into biochar initiatives. And the biochar actually translate into carbon sea sink. And carbon sea sink can actually look to offset 1 million ton of biochar can actually offset 2 million tons of carbon. And that is being done in a very artisanal manner. And that uplifts certain smallholder farmers in Sabah, where they can actually use this to upskill themselves, use this to improve their livelihood, and produces biochar that is environmentally good in a way, right? So they uses palm waste to produce this biochar. So again, it's a circular economy as well. So there's a lot of benefit and impact from this kind of projects. And that project has been successfully certified by CERES. And we have actually produced about 7 million tons of carbon credit. And that carbon credit itself internationally certified, and it can be used already, right? So it depends on how we want to use it right now in terms of trading the carbon credit, or use it for Malaysian exporters that's going out to European market or overseas market. And we know that CBAM is coming in 2026, and that could actually help in terms of improving our economy and improving our stand in terms of where we stand on carbon and sustainability.
Thanks, Win. Over to you, Will.
Yeah, I think just very briefly, I'll just say my reflections from today are really that scale is important, you know. We really need to think big and start acting now in a concerted way and making significant amounts of investment that can really switch the needle in terms of where we're going in terms of emissions. Carbon markets, of course, play a role in that, and we should be, you know, doing what we can to support the development of these domestic carbon markets and focusing on projects which, you know, have multiple benefits. They contribute to the circular economy. They reduce power prices, they reduce costs for businesses, and they reduce emissions and have benefits for the communities in which they're involved. And I think we can focus on those big issues of really how we get scale in this market. The carbon markets are not new, they've been around for a while, they've been through various cycles of hope and depression. It now seems like we are in a new cycle of hope. We have the infrastructure in place, we have the tools, we have the methodologies. Now is the time to scale up if we are to do something to limit heavy induced climate change. So thank you.
Thanks for that, Will. Finn, your closing thoughts.
Yeah, I'm wondering how provocative I can be. And, you know, it's a little quieter and a little bit later, and there's a fewer people here, so maybe I won't get in trouble. But we recently did some research on Indonesian projects, a sample of the projects that we had rated. Avoided plant deforestation and some tropical peatland projects. They are amongst the highest quality NBS projects in the world, you know? And it's great when we rate a project and it looks good. But the research piece also found out that those projects couldn't access any of the 3 meta standards that currently exist in the market, the CCPs, CORSIA, and Article 6. And I guess the provocative question is there something broken in the regulatory architecture we are creating if that is the case? So ratings are designed as a fungible, international, intermarket, interplace assessment. All they do is try and identify quality projects. The market has made a lot of progress in doing that, and I think the risk with some of the regulation is that it undoes actually some of the progress we've made.
Thanks for that, Finn. Last but not least, Natalia. So I'm glad that I get to end this plenary session with a lady CEO and co-founder. Your closing thoughts.
Thank you. Well, what Finn just said is a whole other panel session in and of itself, so I won't go into that. I think I was just going to say, you know, we get a ton, in terms of our insurance pipeline, we get a ton of interest in this region. I think, like Finn says, it has a lot of really good projects. I think both project developers and investors who are headquartered here recognize that, and certainly financial institutions who are headquartered elsewhere are interested in investing into this region. We certainly are very interested in providing insurance here. And so I suppose that is my main point. I think I agree with what William said. I think a lot of the underpinnings are now in place to scale the market. and it's moving into execution. And like Finn said, there's still problems and challenges, but I think it's identifying those and putting in place the concrete steps to fix them. And honestly, I think this is why I'm here, is it is a very, very promising growth area for us. And so I'd be very excited to work with many of you.
Round of applause for our panelists. Thank you, everyone. We hope that you enjoyed that panel session. It has been my pleasure to moderate it. Have a great evening and a safe journey home.